debt capital markets, with you hitting that up, I mean, that's pretty much one of the main movers we're going to be seeing at the moment, with governments obviously trying to raise funds.
Yeah, 100%. Yeah.
In general, I'm just curious about how that's supposed to work when all the governments want to raise funds.
Yeah, well, no, yeah, definitely, yeah. And if you take a step back over the last few weeks and you look at what's underpinning the market and economies at the moment, it's all fiscal stimulus and it's all central bank monetary policy and measures that we've never seen before and some that we have. So if you look at the domestically what the RBNZ have done, last week, if you step back the week before that, the dysfunction across our market was incredible. So, you're looking at say government bond pricing and what yield a government is going to pay for a 5-year bond, a 10-year bond, or whatever. Given the dislocation in the market, the illiquidity, we're literally bumping out 100 basis points. So big moves, like moves that we'd never seen before. With the RBNZ stepping into the market with QE so quantitative easing last week, that helped calm, I think, a lot of the sentiment around the domestic dealer book, so the domestic traders who have to provide liquidity to the market. Those actions by the central bank saved the market from completely self-imploding. So that was one good factor. And they've done bloody well. So
yeah, I was just going to say that quantitative easing, though, they would have, that comes at a cost down the line, right? I mean, obviously we need now, but someone's going to have to pay for that.
The way that you got to look at it, yeah, no, for sure. But the way that you got to look at that is, and this applies to every single country in the world, really, particularly the major economies. If you didn't print money by issuing debt and providing the economic, backstop for companies and people alike, and if you didn't have central banks flooding the market with liquidity, from what I was seeing in markets a couple of weeks ago, to say that we were low probability, but we were certainly heading, if we didn't see the actions being taken, we were heading towards what could have been arguably depression within the next 3 to 6 months. And that's not hyperbole. That's just a fact from what we would have seen. Mass unemployment, financial crises because liquidity had dried up in the market. That means that your companies can't fund, people can't borrow. All of that is the immediate issue that you need to resolve. So you are right. There's if you look further down the track, 18 months or even 12 months and further, we're going to have balance sheets, the government balance sheets, which are going to be chocker with debt, and central banks balance sheets, which are going to be chocker with bonds from various sources. But take the GFC as the working case example that we've got. It was a slow process, but eventually the Federal Reserve was able to reduce their balance sheet. And again, you'd argue that if they didn't take the extreme steps, or what was considered extreme steps at the time, the various facilities that the Federal Reserve provided, the bailouts that were provided, if those weren't put in place, then arguably we would have seen a more dire crisis back then. So yeah, I think what they've done is 100% spot on, and the speed that they've done it as well was needed. So we look at the financial markets 2-3 weeks ago, and the easy one that everyone knows is equities, right? The barometer of the market is your S&P, your Dow, NZX, ASX, depending on which country you're in, and they got absolutely poleaxed. And in the period of 3-4 weeks, they were down 30-35%. Massive moves. But removing that, like the equity side, which is the one that everyone knows about. I mean, if you look at the more important, well, arguably the larger, more important markets that they're the plumbing of our financial system. And that's what I'm talking about, is your short-term funding for banks, your short-term funding for corporates, institutions, medium-term funding, long-term funding, all of your debt markets. If they'd frozen up, and if we got ourselves into a situation like we did back in 2008, 2009, when the financial crisis was on, imagine having a financial crisis overlaid with a health crisis at the same time. So what we were seeing is a lot of pressure in markets, particularly that short end, funding markets, a lot of pressure that we hadn't seen since the GFC. So
and
the central banks,
right? Like it was happening faster because of kind of the compounding factors in the economy.
Definitely, yeah, for sure. I mean, there was actually, there was an actual underlying real economic event. So I guess the way that it played out this time could have played out this time is slightly different. We got hit with COVID. We saw what was going to be a messy economic situation, and then that negative sentiment leapt into financial markets, which started to freeze up liquidity. And then thankfully the reserve banks across the world, central banks across the world, stepped in with some solid measures, which provided, ultimately what they do is they provide US dollars. They flood the world with US dollars. So, the Reserve Bank of New Zealand, for example, has, I think it's a $30 billion USD swap line with the Federal Reserve. So they can, via currency FX swaps, they can borrow US dollars, which is the reserve currency of the world, to shore up liquidity in their in our banking.
Still lend from corporates and things like that otherwise, correct. Yeah.
100%. So I mean, you're allowing the wheels of commerce to keep on spinning because banks are continuing to provide credit to the economy, short and long term. What the government's doing, going back to what you said earlier on, which is a really good point, and it's something that everyone's discussing now, and it's also been reflected in pricing though as well. So the government has to raise, they've flagged 12 billion, let's call it for argument's sake, 20 billion by the time they actually get done after, all of the additional measures and support that they're going to come up with. Call it $20 billion. We're debt to GDP of just sub 20%. In total, public debt was around sort of circa 75 billion. So you're going to be adding another, call it 15, 20 billion over the coming 12 months, 18 months. At the same time, you've got Aussie raising upwards of 150 billion plus. You got the US government raising a heck of a lot of money. That's a slightly different story because they're the reserve currency. But France, Italy, UK, all of your major economies are going to be raising money at the same time. Where I guess you got to look at it is there's always going to be the way that the market determine those prices off the perceived risk of any economy. So you might have, Italy, for example, a lot bigger than ours, but lower credit rating. We're a AA plus rated country. We've been fiscally prudent over the last few years. We've got the headroom, and all the economists are saying this, and it's true. Like because of the approach that successive governments have taken, and it's given us the to take the debt that we're about to prop everything up. Where things are going to stop. I mean, imagine if we get slammed with another natural disaster or something like that. So, yeah, it's where I guess it is concerning, but we'll definitely get away.
Yeah, New Zealand, I think, is definitely in a better position to weather this than other markets. Although I guess in saying that, it'll be interesting. Our tourism market's obviously not in a good place, as is nowhere, and we think that's one of our main exports. And then also, it'll be interesting to see with agriculture, one of our other major ones, if we end up weathering this better than some of those other countries, then obviously we end up with a stronger NZ dollar. And how does that impact, therefore our GDP as a country as well, though?
Well, it's interesting. So you're talking about like offsets across the sectors. So tourism, take the obvious impact of shutting our borders, and the likelihood into New Zealand. So that's tourism done, and you'd say education, which I think is our third biggest export, isn't it? Or certainly it's up in our top 5.
Yeah.
So that's two of our major exports done, and then you're left with agriculture. Now, where I think you would say we would have an advantage is due to the fact that we ship a lot of our goods and it's food, it's necessities to China, and we know China is starting to open their ports, the economy is starting to open up again. So, there is a bit of an offset there, but the currency is always a hard one.
Like packaging and it's not coming through passenger planes, then
so it's interesting. I think you'll see repositioning with a lot of the Auckland Airport, for example, is a logical one. If they're not going to be shipping passengers, they're going to be talking with logistics companies around and exporters, etc., around how they can utilize their infrastructure, their resource to deliver offshore or deliver. There'll be workarounds everywhere, you know. I mean, the thing is, given just the effect on multiple sectors, hospitality, the ones that we already mentioned, you know, you've got to, companies will start thinking outside the box, and they'll also start rediverting assets to areas where you are seeing activity. You know, the number of economists looking at.
I guess that's where there's a lot of opportunity, like as you say, you know, New Zealand looking at their infrastructure and how they can use that to aid agriculture. That therefore helps kind of some of the tourism industry if they can use that. Same thing with like lots of the remote companies. I guess there is technology opportunities now, like you were saying with Zoom before, with their stock increasing over the last 3 while.
Technology and, you know, companies repositioning themselves. I mean, all of it ultimately is going to be a small, marginal. This is going to be a serious hit.
Yeah, that's only kind of going to.
And you know, they're talking about unemployment up to sort of 7 to 10%. Yeah, exactly. But I mean, you know, what the whole point of what the government's doing is to bridge the time between the worst of the COVID crisis to a period where you've got vaccines being offered or some sort of antiviral treatment to buffer the impact on our health system. You know, the Atlantic did a really good article the other day, and definitely read it if you get the chance. It says, I think it's entitled, "How Does the Pandemic End?" And effectively they go into, you know, a lot of it's US centric, but at the end of the article, they go into how different scenarios might play out. And they go into a bit of detail around the vaccine timeline, and you're still looking at a 12 to 18 month period between, say, a viable vaccine being discovered to the trial periods, animal testing, you know, eventually getting it to human testing, and then distributing in any sort of scalable way. You're looking at 12 months, 18 months. And so, you know, the ideal would be for us to go through this lockdown, keep the passenger numbers. Yeah, exactly. So fingers crossed we get to the other end and we aren't, you know, like, I think people have been using the term hibernating companies. I mean, it's true. You got to, and, you know, it's not like we can provide endless financing and liquidity to companies who aren't producing, but, you know, and you have to be, I guess, and the government has to be selective with how they support. And, you know, 900 million to Auckland, to Air New Zealand makes sense, right? It's our strategic national carrier. You'd say a number of other strategic assets that the government's going to step in and make sure they don't fail. And that all makes sense. And the whole point is to try and cushion us during the worst of it. It's out the other end, vaccines, which is, you know, is a long way off. But so yeah, there's a lot of crap. I mean, this market bounced last week, and this is one thing I'd say. It's go back to 2008, right? So who remembers 2008? I don't. But if you look at last week, 3 days of the market went up 20%, right? In 2008, they had in October, the market went up for a 3-day period around, call it 25%, I think it was. Went back down again a few weeks later, end of November, went up 27%. And then during the turn, so between Thanksgiving and the beginning of 2009, it bumped up again like 25%-ish. And then, of course, it settled at the bottom of the trough of the GFC at 50% down. Last week, to me, is an aberration. I mean, the market's move was predicated on the stimulus package in the US in particular and others throughout the world, buffering economy extent that, you know, we aren't going to see the, I guess, the employment, the mass that potentially we may have seen if it didn't happen, if those bailouts, or not bailouts, so if those measures weren't taken. But, you know, that doesn't mean that, I still don't think that the prices correctly incorporate what is going to be a protracted, disrupted downturn over the coming months. I mean, you know, we've only seen a prime example. If you look at the PMI, which is some measures out of Europe that were released a couple of weeks back, sub 50 number is a contraction in services and manufacturing in the Eurozone, and they were horrendous, and they were well below what the market was anticipating. So firstly, we've got no visibility on how bad this shit's going to get. Secondly, look at the jobless claims out of the US last week. 3.8 million.
It's way worse than the GFC.
Right. So, but I mean, that may be the worst number I'm seeing.
The GFC as well was sort of central to the state, and then obviously it carried, the impact carried. Whereas I think everyone is, like, the virus is a direct threat to every nation this time. So I feel like globally, governments have stepped in and provided those packages, and that's why, you said it wasn't, they're coming through, and we are seeing some of that impact straight out the gate. But I think you're right. You made a good point earlier where you almost need to separate, because we were due for a recession anyway in a lot of ways, but this virus just ended up being the catalyst, I guess. So if we can just separate the two and deal with first the health crises and push past that, and then you can have some hibernating businesses that just are getting passed on their, like, getting through on the bare minimum, then when we come out and we're in the recession, we can deal with, like, the fiscal implications and kind of.
I look at some of your, if you want to make a play on the market without delve into the research yourself, either go through a cheap provider of like an index tracking fund. It's a macro view of the market picking up by a certain amount over, let's say that you think the bottoms when equities have fallen 35%, whatever, and you want to have some exposure to the market. Well, then you can go some of either via an index tracking fund. I think Simplicity is an example. ETFs are good. They're, if you can get an offshore, offshore broker. I think some of the brokers here do it as well. They can provide some sort of exposure to an exchange traded fund. To be fair, there's a bit of redemption risk in that.
To take this to a basic level as well. In terms of KiwiSaver, I know we both moved ours into cash before that happened, and so I haven't seen much of a drop in mine at all. Don't know about you, but it's just kind of stayed the same.
No, I kept it in cash as well. Don't have the balls to jump in just yet.
No, I'm not jumping back in quite yet. But an interesting one is for people that haven't made that move. Do you think now to change that would be to realise the loss, or do you have like a bad enough outlook, I guess, essentially, over the next sort of year or so that you think actually to change now and lose several thousand could still be better than to hold until a year? I guess that depends on what your view is of the recession. Is it
it does.
Is it pick up in a year, or is it 5 years? That's kind of what it comes down to. It's an interesting one because I know people who haven't moved to cash and are in a bit of a bind now.
Well, I mean, that's the thing. Markets are, again, just using equities, are down sort of 20% from the highs. Precious touch more now from Friday's trading, so 20 to 25%, depending on what index you're looking at. It's a hard one. I mean, if you think the forming a view is hard as well. I mean, I don't know. Personally, if it was me, I probably wouldn't move. I don't think so. Let's say that you go. I mean, and the reason being is that the central bank actions, going back to this, and I'm harping on about it, but they are unprecedented. And if you look at the performance in markets over the last post GFC years, from credit markets, all asset markets, in my mind, have been propped up by central bank action. So central banks have determined and stepped into the global markets, particularly the Federal Reserve and the EU, or ECB. Sorry, they've stepped in and priced credit across the globe. And when you buy that much in the way of bonds, and you drive yields down in your credit markets and your bond markets, people are going to look for other assets with a spread and a return. So they start looking at equities, because equities are going to provide a capital return. They might provide a dividend yield, which is higher than what they're going to get if they buy a bond. Prime example, if you look at your high yielding, the number of high yielding bonds out there, I mean, it absolutely blew through the roof post GFC, because people are moving down the risk curve, taking on board more risk to trying to get, eke out a little bit more return. What's going to be different this time around? Well, the economy could be really slammed and fundamentals override the technical backdrop. What I mean by that is, the actual underlying strength of a company overrides the wall of cash that's propping it up. And this is the reason why I'd say possibly stay in, I would, given the dip that we've already seen. The central bank actions are probably going to keep things from falling too far. And you'd probably argue that they would take additional steps to ensure that it didn't fall too far. So you've almost got what was called the Bernanke put back in the day. Now you've got the Powell put. And it's true, because you just sort of, you look at it and you're like, well, shit, the central bank's going to back us all. So they take on board the risk. We can sit there. Yeah. But I mean, I still reckon it's going to go down further. I mean, put it this way, I think for me personally, I'm looking for like a 35% dip across equity markets is, again, just being the easy measure to look at. And then I might jump back in. You can apportion your KiwiSaver as well. If you can do a 50% across a couple of strategies. So that way you've got a slight hedge in place, and you're not even losing money off the hedge. You're just not losing money. Well, sorry, you're not losing money on your cash. Yeah, exactly. You're possibly going to be losing some on your more aggressive strategy, but.
Yeah, but if you do that at the right time, as you say, if you think it's 35 and you're sort of at the end of the dip there, and then you're anticipating it rise up. I guess right now the question is like, how close are we to the bottom? Because if you change now and then you realise and you're at the bottom, then unlucky. But yeah, it's an interesting one. I myself would leave it because it is looking, not so good now, and I feel like, based on what we have seen from the Reserve Bank and government, like I think that they are going to prop things up where they can. It does seem like this is, well, everyone keeps using that word unprecedented, but unprecedented. So I guess we'll just see what happens in the next little while and how long this lasts. But I think you're right. Essentially, like COVID, like we need to get through this health crisis first, and that's like the strategy that the government's putting in play, and obviously there's quantitative easing and everything like that we're going to have to pay for down the line. But at least if we can sort that, cross that off, and then get to kind of the fiscal crisis that we're left with, I guess then they'll, I have to put some strategy
definitely the plan
to kind of work out those balance sheets.
Fingers crossed.
Anyway, thanks so much for catching up. I will. I'll keep in touch and see how you're going. Hope that you're
good luck
working at home with the boys.
Well, maybe in 2-3 months' time we can have a drinking game when we're allowed outside. Christ.
Yeah.
Hey, if you want to do any babysitting of my 3.5-year-old twin boys, you are more than welcome, by the way.
Oh, okay. Well, look, based on current levels of employment, I won't write that off, Cam.
Yeah, exactly. Good work.
All right. Have a good day.
You too. Bye.